Hello, everybody. Thank you for joining us today. We're going to start right on time as people are finishing to log in. Mike has a full presentation for us today and a lot of information, so just want to make sure that we have enough time for it. So just want to thank you again for joining us today. This is the captive insurance update from Mike, so hopefully you are in the right place. Today, we will review the history and provide an overview of captive insurance. We will discuss how it may be a way to reduce your insurance costs and develop alternative revenue streams. Mike will review the various types of captive insurance programs and arrangements commonly used today and the steps involved in implementing these different structures. I'm Carolyn Powell. I am the development director here at Tronconi Seguer & Associates. I'm going to be the host. I'll go quickly through the housekeeping so Mike has all the time that he needs to go over everything. On the toolbar, it probably will be on the right-hand side of your screen. There is some handouts over there. You can get a copy of the slides. There's a bio of Mike so you can get some more information, and also an appendix that he'll be referring to during the presentation. You can download those at any time. If you have any questions throughout the presentation, in that toolbar is a section for questions. Throw something in there and we will get it answered for you. At the end of the presentation today, there will be a survey that's directly emailed to you as you close out. If you could just complete that, let us know how you did, if you had any questions, and if there's any other topics you want to see over the course of the year. This webinar is recorded. I will send an email out this afternoon to everybody with the link to the recorded session, a copy of the slides, the appendix, and Mike's bio. So I think that is everything in the homework, so in the housekeeping. So let's get us started today. Mike Baritot, he is an MST, that's a Master of Science in Technology. He has over 30 taxation, sorry, over 30 years in the accounting industry and a broad range of industries and experience. He works closely with individuals, business owners, and families to grow and preserve and distribute their wealth while minimizing their impact on taxes. So before I hand it over to Mike, we are going to do a quick poll so he can better understand where everybody is at. Let me just pop over there. And I am going to launch the first question. How many of you have seen significant increases in your insurance premiums, both personal and business, related to the past few years? Mike, where do you think people are going to come in on this one?
I think they're going to be fairly significant, and I think most are going to have experienced some of that. Yes.
Yeah. All right, we'll give everybody just a couple more seconds to fill that out. All right, I'm going to end it 3, 2, 1, just to keep us moving. And yes, looks like 93% of people have seen a significant increase.
Not surprised.
Right, that's why everyone's here today. So the next question I am going to ask, and then I'll turn it over to Mike real quick, is how many of you in managing your own auto, homeowners, or health insurance have opted for a high deductible insurance plan? All right, okay, we've got a little bit range of different answers here. Let everybody get voting and then jump right in. Okay. I'm going to close it in 3, 2, 1. Just share it real quick. 67% said yes, they have. Some have to think about it, some have no idea, and some of them luckily have not had increases. I feel like I need to knock on wood for those people. So Mike, with that information, I'll let you jump right into it and also tackle this question for our folks.
Well, for those that have had no insurance increases, I want to know who their agent is. I want to talk to whoever they are. Thanks, everyone, and good morning, or good afternoon, I guess. We crossed the line into the afternoon. Those of you that have opted to take advantage of a high deductible plan, you've essentially participated in a form of alternative risk management. This is what we're going to be talking about today, alternative risk transfer. You've essentially retained a portion of your insurance premium dollars, and in exchange, you've assumed that first $500 to $1,000 or more of risk. You're basically betting that you're a better risk than the insurance company thinks you are, and that you can profitably manage that layer of risk to your own personal economic benefit. We first presented this topic of captive insurance about 2 years ago, and there was quite a bit of interest then. I think if anything, there's probably more interest given what's going on in the insurance markets today. Today's presentation will cover much of the same material that we covered 2 years ago, but with the addition of some important developments that have occurred, particularly in the past 2 years. So here goes. Let's start with the premise that insurance companies are in business, just like any other business, to make a profit. They make those profits by collecting from their customers more in premium dollars than they're required to pay out in loss claims. They can determine the pricing for the products and policies that they deliver. If they charge too much, customers will go somewhere else. And if they charge too little, they'll lose money. But unlike almost any other business, they really have no idea what their ultimate cost of goods sold, if you will, is going to be. All they can do is rely on actuaries to estimate what their costs are going to be and set their premiums accordingly. The rest is up to chance, and in many cases, as we've often seen with natural disasters in a few years, it's often up to Mother Nature. So with profitability on the line and the uncertainty of loss payouts, it should come as no surprise that insurance companies tend to play it safe, to err on the side of charging too much premium rather than too little. The greater the uncertainty as to the frequency and volume of loss payouts, the higher the premiums need to be. We only need to look at the insurance markets in Florida and California with respect to the last couple of years to get an idea of what's going on with that concept. And so it's this dynamic, if you will, that created the alternative risk transfer industry, also known as captive insurance. I've been involved in all aspects of forming and managing captives and defending them against IRS challenge for most of my 30+ years in the accounting and advisory industry. So if you go to the agenda, we'll talk about what it is we're going to try to cover with today's session. First, we're going to talk a little bit about the history of captives. We'll talk about how they began and some of the unique business risks that gave rise to the proliferation of captives over the years. We'll talk about how the IRS has reacted or responded to the captive industry, the ways they've attempted to defeat the concept, and some of the changes that have occurred, particularly over the last couple of years. We'll talk about some of the characteristics that might lead a business to consider a captive and the benefits, both tax and financial. We'll also cover the unique tax benefits that are afforded to micro captives, 831B captives. Then discuss the steps involved in setting up a captive. And finally, we'll review several examples that will help to put this whole concept into perspective and help you to understand where and how it can be employed. And at the end, we'll hopefully have some time for some of your questions. So the concept of captive insurance is attributed to an Ohio insurance agent by the name of Fred Rice, who in the 1950s, and in response to skyrocketing commercial insurance policies, figured out that the Youngstown Sheet and Tube Company, a basically steel manufacturing company, could set up its own insurance company to insure its coke and iron mining operations. Fred Rice is recognized by an award that bears his name to this day, and it's given annually within the captive insurance industry for lifetime achievement in the captive industry. The concept started to become really popular in many industries as a way to reduce insurance costs and to cover risks that were uninsurable in the traditional markets. The appendix that Carolyn mentioned is a more exhaustive sort of analysis, if you will, or summary of how the industry has evolved over the past 40, 50 years or so. And I commend that to your attention if you have more interest. We do not have time to go through that in details today. We will touch on certain aspects of it for sure. Your typical single parent captive structure looks something like this. You have a parent operating company operating a business, and it decides to form a wholly owned captive insurance company underneath it as a wholly owned subsidiary. The parent company pays premium dollars into the captive insurance company and in exchange receives insurance coverage. The key benefit to this structure from an economic and a tax perspective is that the captive, as an insurance company, a regulated insurance company, has the ability to deduct reserves for future losses. The parent company, under the tax rules, does not have that ability. Insurance companies are really about the only legal entity that have the ability to deduct reserves for losses that are not going to be paid until sometime in the futures. And that's why the IRS doesn't like this so much. It hasn't from the beginning. The IRS aggressively fought these types of arrangements for over 30 years. They didn't like it from the very beginning. And they used a number of arguments on a fairly consistent basis in challenging these arrangements in various court cases. The first one was an economic family argument, that the arrangement lacked risk shifting outside the group of related companies. The second argument they used was something more of a legal construct, the nexus of contract, which basically is another way of saying that the parties were not independent and therefore this transaction should not be respected. Another concept was assignment of income, and that the transfer of money from the parent to the captive was not a valid premium for insurance coverage. They tried and they tried, and although in many cases they were successful in lower court proceedings with these arguments, ultimately, very few of them, if ever, succeeded upon appeal. Where the IRS has been successful is in situations that were poorly structured, abusive situations, where companies engaged in unrealistic premiums, covering unrealistic risks, and it looked just like somebody was creating a piggy bank with deductible premium payments. The taxpayer victories over the course of time, primarily through the 90s, created a set of standards that taxpayers began to use on a fairly consistent basis to support and justify and structure their captive insurance arrangements. Sometimes referred to as the Harper standards, but there were three key cases: Sears, Americo, Harper, all that came out in the early 90s, all taxpayer victories. And so what came out of that was the notion that if you could meet these standards established within these cases, your arrangement, your captive arrangement, would be respected as an legitimate insurance company. So the standards were as follows. We've got to establish that the arrangement involves the existence of actual insurance risk, real insurance risk, not something that is unlikely to ever occur, but legitimate insurance risk. You had to establish that there was both risk shifting and risk distribution. So the financial implications of that risk had to be shifted to another entity, and you had to have significant distribution of that risk across a broad number of policyholders, not just one policyholder. and whether the arrangement was for insurance in its commonly accepted sense. And finally, the old duck test. Does it look like a duck, walk like a duck, or should it say like an insurance company? If you follow the rules and can meet all these tests, this notion was that the service would have to cave, would lose in court and wouldn't pursue a case in a company that met these standards. Another 10 years or so passed, and with more and more taxpayer victories and more taxpayers following these rules, the IRS finally waved the white flag and said, okay, we know we're not winning, and we know we're creating a lot of uncertainty in the markets. We're going to step back and we're going to create some guidelines that if everybody follows these guidelines, then we will respect these transactions as they were arranged. And so a series of rulings came out in the early 2000s. The first one being Ruling 2001-31 that abandoned the IRS's favorite economic family theory. They threw that out the window. Then in 2002-39, they also came back and said, all right, if you have at least 50% of unrelated party risk in your captive, we'll respect that as meeting the risk shifting standard. And then in 2002-90, they established another way of achieving risk distribution through the 12 subsidiary test. And that test said, if you're a parent company and you have at least 12 subsidiaries and you have a captive insurance company that insures those 12 subsidiaries, then you've essentially, even though they are commonly owned, you have spread that risk across enough different entities, even though they're commonly owned, to achieve risk distribution. And finally, and this was an important one for the industry, 2002-91, the service approved the establishment of homogeneous group captive arrangements. And we see a lot of that today. We'll talk a little bit more about that. But these were big victories that really gave rise to a proliferation of captive insurance companies and a tremendous growth in the industry, because now we had a set of guidelines, a roadmap to follow, and if we stayed within these guidelines, we knew we were going to be respected as an insurance company. So let's talk a little bit about who should form a captive. First, it's important to recognize if you do, decide to go down this path, it's important to recognize that you are in the insurance business with all the risks, the costs, and the benefits associated with it. So it's not like setting up another subsidiary to sell XYZ widgets or whatever. You're getting into an entirely different industry that has a lot of different business economic risks associated with it. But companies that typically look at a captive are ones that have an above average risk profile. What these companies want to do is separate themselves from the general population that falls under your typical third-party insurance companies. Again, think of California wildfire insurance, think of Florida flood and hurricane insurance. Everybody is bundled into these third-party insurance companies and they're paying for all the risks that everybody incurs under that. So if your risk profile is better than the average population, you're likely to benefit from having your own insurance company. Companies or individuals with the financial resources to contribute to a captive. It's not, we'll get into some of the details on the financial commitment that's involved, but you need to be able to tie up a substantial amount of dollars for an extended period of time in order to go down this path and form a captive insurance company. And the company should have the right combination of income and risk. Different service providers will give you different numbers. 3 to 5 million in gross revenues would be a minimum, and 300 to 500,000 in insurance premiums would be a minimal starting point to consider a captive. Types of companies that are best suited for a captive, and some of this is discussed in the appendix in terms of how the industry developed and the types of companies that first entered into these types of arrangements. Doctors and other professionals with malpractice exposure, they got involved particularly a lot in the 70s in setting these things up to cover their malpractice exposure. Manufacturers to cover their product liability exposures. We saw a lot of growth in that area in the 80s. Auto dealers selling extended warranty policies on used vehicles. These tend to be very profitable policies. The premiums generally far exceed any of the claims, and they like to retain some of that underwriting profit if they can, and they can do it through a captive. Exporters and importers, supply chain risk can be significant for them, and a captive is often a good way to minimize the cost of covering that risk. And then real estate developers, why? Because they typically are structured in a way that involves multiple legal entities, so they can easily meet that 12 subsidiary test that we talked about for achieving risk distribution. Other companies that have found captives a good option. Dry cleaning that have environmental risk, believe it or not, a dry cleaning company, those of you who have been around or know how they get your clothes clean, there's a lot of nasty chemicals involved in that process that lead to environmental risks around the properties that are owned by those companies. Construction is another area. So contractors, HVAC, electrical, plumbing. I actually had clients in the 90s that were involved in construction, and then as there was a tremendous growth in the business of asbestos removal. And companies looking to get into the business found that one of the key barriers to getting into that line of business was trying to find anybody to cover your workers' comp expense, your workers' comp coverage. It was largely unattainable. So a group of these contractors from around the country got together and formed a Bermuda captive. And the contracts themselves were very lucrative because a lot of it was done on a cost plus basis with government entities that just wanted this asbestos removed. And the quickest way to, cost was not a huge object. So they passed the cost of the premiums on to the customers. The premiums accumulated within the captive, the losses never materialized. And in many cases, these contractors made more money on the dividends that came back from the captive insurance company than they ever did on removing asbestos. So in the right situation, it can be extremely lucrative. Oil and gas companies, hotels, motels, restaurants, these are all examples of industries that have benefited from captive arrangements. Transportation companies, simply because they have significant auto and GL liability exposures, and those coverages get lumped in with a lot of bad actors that drive high premiums. They can certainly benefit from a captive if they have a better than average track record in loss ratios. And then any company that provides some form of guarantee or warranty to its customers, along with the goods or services that it offers for sale. Again, the auto dealers are an example of that. I've worked with other companies over the years, one in particular that manufactured rubber roofing materials that were sold to contractors for installation, and then they would sell along with that product a 20, 25, 30-year warranty for the performance of that material, and they benefit greatly from running that business through a wholly owned captive insurance company. So what are the benefits of forming a captive? Again, we talked a little bit about the ability to customize your insurance policy. We sometimes refer to the Beech aircraft case. So Beech aircraft produced high quality personal aircraft, and they were considered a high quality manufacturer. But They weren't the only manufacturer, and there were some inferior manufacturers, and their loss ratios were a lot higher than Beach, but their premiums were being set by the industry, not by their own experience. So they used their individual loss experience and set up their own captive. This was not, unfortunately, a taxpayer victory because they didn't really follow the rules properly. They had the right idea and the right concept. They did not achieve the proper risk shifting and distribution because they only had 10% unrelated risk in their captive. So they lost in tax court, had the right idea. Again, poor execution sometimes leads to poor results. One thing to keep in mind, it's important that one reason people go into these arrangements is the insured company can gain some significant negotiating leverage with their third-party insurers. So third-party insurers in this situation would take on the standard risks, the low volume, the high frequency types of risks that can lead to fairly predictable premiums. But then the company sets up the captive to take on the specialty risks, those high volume, low frequency risks that tend to lead to unpredictable premiums. The companies get hurt if these two types of risks are both positioned with a third-party insurer, because the third-party insurer is going to overcharge for the standard risks to cover up any potential additional losses at the non-standard unpredictable risks. And so that's another reason for carving out and creating some bifurcation to gain some negotiating leverage with your third-party insurer. Some of the benefits of forming a captive, continuing on, it can be used as a wealth transfer vehicle. So it does not have to be, captive doesn't have to be owned by the parent company, and it doesn't have to be owned by the owners of the parent company. In some cases, you will see captive ownership transferred to the next generation of a family business to create a way to transfer wealth down to that next generation. And then we're going to talk a little bit about 831B, the small insurance company exception. 831B was added in the 1986 Tax Reform Act. Today, it allows for the accumulation of up to 2.8 million in premiums. That year, that number goes up every year for inflation. And if you make the election and fall under that $2.8 million threshold, you have the ability to be taxed on your investment income only and not on your underwriting income. It's a very unique situation with significant tax implications, pretty unusual in the world of taxation. These companies are often referred to as micro captives. And what happens here is the insured entity is able to lower its income by the amount of premiums that it pays to its wholly owned insurance company. The premiums that are received by the insurance company are part of the company's underwriting income, which by statute under 831B is not taxed. So we have money that flows from one company to a related company. And the result is a deduction for the parent company and no income on the insurance company. A very uneven result, a very unusual result, and one that the IRS is not thrilled about, but that is the law and that is the statute. In these scenarios, typically after the non-taxed underwriting income and the taxable investment income have accumulated, the captive shares can be sold or liquidated at capital gains rates. So with this, we can achieve both tax rate arbitrage. In other words, having income taxed at capital gains versus ordinary income rates, and also tax deferral, having that income deferred many years down the road until we ultimately wind down the captive. The IRS activity in this area is covered a little bit more detail in the appendix. I'm just going to touch on some of the highlights here. The law was changed. Remember, I said it originally came into being in 1986. From 1986 until 2015, that premium threshold didn't change. And it was originally 1.2 million in 1986. So in 2015, they bumped it up to 2.2 million, and then also added on the annual inflation adjustment, which got us to where we are today at 2.4 million. But once this change took place, the IRS took real note of this and realized, okay, what we used to worry about at 1.2 million is going to be a much bigger issue now that it's 2.2 plus million. So in 2015, they added these structures to what they refer to as their dirty dozen of tax scams to watch out for. And then to raise the ante another level, they issued a notice in 2016 that required all these captives and their owners and their advisors to provide specific notice to the IRS and disclosures about all these arrangements with their tax filings and other filings. It was kind of a knee-jerk reaction, and it kind of blew up in the IRS's face. There was significant industry and taxpayer pushback, and then the IRS actually lost in court on this notice for failing to follow the appropriate administrative procedures and provide proper notice. Then along came a tax court case in 2017, which flipped the tables a little bit, and the taxpayer lost on this one. But again, it's a situation where the design of the structure, the design of the plan was seriously flawed, and that's really what led to the taxpayer's defeat. Between 2016 and 23, there was a lot of activity around and a lot of question around who and what needed to be filed with respect to disclosures. IRS requiring, on the one hand, everybody to disclose, courts coming back and saying you didn't follow the right rules, so nobody has to disclose, or maybe some you have to disclose. It was very confusing, to say the least. So in April 23, they kind of went back to the drawing board, and they obsoleted their notice, pulled it off the table, and issued proposed regulations. And this was their attempt to sort of recognize that they had made a mistake in 2016 and now go through the proper procedures of notifying taxpayers, issuing proposed regulations, and then receiving comments, and then issuing final regulations. Those final regulations were actually just issued in January of this year, and they made substantial changes in response to comments they got back from taxpayers, from the captive insurance industry, and from the general insurance industry. And the regulations are an attempt to set forth now standards that will identify potentially abusive situations and impose upon those situations and the participants in them significant tax shelter reporting requirements and the potential for significant fines in an effort to disincentivize these transactions. So let's take a look at the final regulations. In order for these to apply, we first have to have a captive. The captive has now become a defined term in these regulations. And in order to be a captive that is subject to these regulations, you need to meet all three of these tests. So the first one is that you made the election under 831B to be taxed on your investment income only. So unless you made that election, you're not considered a captive in the eyes of the IRS. Second requirement is that you issued insurance and reinsurance contracts. Well, that's kind of obvious. If we're an insurance company, then obviously we issued insurance or reinsurance contracts. The third one is 20% common ownership with insured or related parties. So this essentially is going to cover all single parent captives. However, it's not going to encompass or cover any of the homogeneous group captives because their ownership is typically spread across a group of unrelated businesses, companies, individuals that just happen to be in the same industry. So there's two types of captive arrangements that are subject to the disclosure requirements. The first, listed transactions. This is the more serious, from the IRS perspective, more abusive arrangement. And to fall into this definition, to fall into this trap, if you will, two requirements have to be met. First, that it is a financing arrangement. So what does that mean? Effectively, what that is a scenario where the company, either directly or indirectly, the company being the operating company, not the captive company. Remember we said you need to typically tie up a fair amount of capital within the captive for an extended period of time. So this is an arrangement where the owners or the policyholders attempt to somehow avail themselves of the benefit of that collateral without taking it back as a dividend or in some other taxable event. So they use it as to collateralize a loan or some other arrangement where they receive the economic benefits of having that asset even though they don't have it in hand and even though they haven't paid tax on it. The second requirement is a loss ratio. So this would be a scenario where if over a 10-year period, the company has paid less than 30% of its premiums out in losses, then you've met this test. That is kind of suggestive of a fairly close to abusive situation. If you're paying in $100 of premium every year and over a 10-year period of time, you've only paid out $30 in losses, it looks like you're conducting something other than an insurance business because no insurance company is that profitable. So those aren't particularly punitive tests to meet. But again, keep in mind, you got to meet both of those in order to fall into this listed transaction category. And I think these situations will be rare in companies that are well managed and and well executed in terms of meeting their planning needs. The second type is a transaction of interest. So again, there's two requirements, but in this case, it's an either or. So we only have to meet one of these in order to fall under this definition of a transaction of interest. So it's a little more pervasive. Again, the financing arrangement, same definition as before, any attempt to take advantage or make use of the value of the assets in the captive without triggering a taxable event. And then the loss ratio here, quite a bit higher. So if the captive has paid less than 60% of its premiums out in losses over a 10-year period, then you've met this test. So this is going to catch a lot more people. And again, it's an either or. And the other thing here is this test can be met before 10 years if it's not been in existence for at least 10 years. So again, going back, the listed transaction, nobody's going to be a listed transaction until they've got a 10-year history. The transaction of interest, you can still be a transaction of interest even though you don't have a 10-year history. Just sort of remember this, by definition, a listed transaction will always be a transaction of interest, but a transaction of interest will not necessarily be a listed transaction. Hope I didn't confuse you too much. All right, some important exceptions to these rules. We mentioned homogeneous group captives. Just by virtue of the nature of the groups and their ownership across a group of unrelated parties that happen to be in the same industry, they would not meet the third requirement of the definition of a captive for purposes of the regulations. So they don't have to worry about these rules. The regs introduced a new concept into the tax vernacular called a seller's captive. And this is a scenario where A company that is in the business of selling goods or services provides, along with those goods or services, an extended warranty on the products or services that it is selling. So if you meet this definition, you will not be subject to the disclosure rules. So, and again, this is a 4-part test, and you need to meet all 4 parts in order to qualify for the exemption. First, the captive is related to the seller through common ownership, and related party rules apply. So family relationships apply to create that needed relationship. Second, the captive insures risks of unrelated customers of the seller. Third, 100% of the insurance business is related to risks associated with the products or services sold by the seller. What does that mean? Well, it means if you have one of these captives that you're using and you're writing this kind of insurance, extended warranty insurance on the products or services that you sell, you cannot, on top of that, throw other types of risks or other insurance policies into this that are not seller warranties. You can't throw those in there and put them together into the same company. You'd have to carve them out and run those through a separate company. And then 95% of the business has to be with customers that are unrelated to seller. Okay, assuming we fall into that bucket of either being a listed transaction or a transaction of interest, and we don't meet the exceptions that we talked about, what are the disclosure requirements? Well, the IRS has prepared a nice little form for us, Form 8886, the reportable transaction disclosure statement. The regs require that these reportable transaction statements are filed by the captive itself, all of the owners of the captive, all of the insureds, any intermediaries, as well as any material advisors. So all these parties have to file this Form 8886. The captive has to provide details on the types of policies written, contact information also for the actuaries and the underwriters that they used in determining their premiums. These forms have to be filed with the tax returns for each year that the parties participated, and they also have to be filed with the IRS's Office of Tax Shelter Analysis. Now, it's interesting, the regs also mentioned that you can avoid filing Form 8886 if you simply revoke your 8031B election. And they provide guidance on how and when you might be able to do that to avoid these filings. Assuming we go through this and we decide we still want to form a captive, let's talk about some of the steps that would be involved in forming a captive. First step typically is a feasibility study performed by a captive advisor, which has 3 objectives. Provides a blueprint for the captive program. It provides assurance that the program complies with relevant insurance and tax laws, and it provides the key decision makers with the tools that they needed to assess the plan. Then we need to select a jurisdiction. It could be a US state, it could be a foreign country. The regulators in the selected jurisdiction will consider things like the character, reputation, financial standing, and purposes of the incorporators, the character, reputation, financial responsibility, insurance experience, and business qualifications of the officers and directors, and such other aspects as the insurance regulators shall deem to be relevant. Needless to say that the regulations vary from jurisdiction to jurisdiction, and part of the art in forming one of these is to have a captive domicile advisor help you address and assess and identify the domicile that is going to both be most favorable to the line of businesses that you're trying to write. It's also no accident that many of these jurisdictions tend to be in popular vacation destinations, because most of these jurisdictions require an annual meeting at least once a year in the jurisdiction. And the governments have figured out that this is an easy and inexpensive way to generate fees for their insurance department and promote tourism. So it's why you see Bermuda, Cayman, Vermont, Utah, Hawaii. That's why you see some of these types of jurisdictions being popular destinations. So the continuing on with steps to forming, the applicant will need to make a formal application to establish a legal insurance company in the chosen jurisdiction. The applications vary from jurisdiction to jurisdiction, but will generally include the amount and description of the assets relative to the risk to be assumed, the adequacy of the expertise, experience, and character of the persons who will manage it, the overall soundness of the plan of its operation, the adequacy of loss prevention programs of its members, member organizations, or industrial insureds, other factors that are considered relevant by the regulators, and of course, capitalization will need to be determined based on premium volumes and the expected risks to ensure a sound financial structure. All of these are things that nobody who's setting one of these up is necessarily going to have the knowledge or expertise to address. So this is where the use of outside professionals comes in, and they fill the gap in terms of that knowledge expertise. So who are some of the professionals that you'll need to engage in this effort? A domicile manager who is typically resident in the specific domicile, legal counsel that is knowledgeable both with the domicile and general insurance regulations. Auditors need to be engaged pretty much in all jurisdictions. You're going to need a certified audit from a CPA firm on an annual basis, in addition to the annual statement that you file with the insurance regulators themselves. Actuarial services, so that you need actuarial reports and analysis to determine what the premiums are and what the losses are going to be at the end of the year. And of course, an investment manager to manage the accumulated investment assets that are there to address and pay for future losses. Some of the circumstances that can lead to a captive being shut down would be insolvency or impairment of the capital or surplus, failure to submit the annual report on a timely basis. This would be the annual report that is filed under the National Association of Insurance Companies form, which can be anywhere from a 50 to 70 page detailed form that needs to be filed with the insurance regulators. Failure to comply with its own governing documents, articles, or bylaws. Failure to submit to an examination by the insurance commissioner. Refusing to pay the cost of an examination by the insurance commissioner. Yes, you as an insurance company get to pay for the regulators coming in and examining your books and records. Imagine having to pay the IRS for an IRS exam. Well, that's what happens in the world of insurance. You get to pay the regulators to come in and examine you. And any failure to comply with the captive statutes in the jurisdiction that you're operating. What are the fees? You can expect to pay $25,000 to $50,000 as a starting fee, just to get the ball rolling, just to get you probably through the feasibility and the design phase of the program. On an ongoing annual basis, you can expect to pay $15,000 to $20,000, and this does not include things like reinsurance, risk distribution strategies, accounting and tax fees. Just as this is a basic sort of insurance business management fees that you're likely to incur. So what I wanted to do with the remaining time we hear is just run through a couple of quick examples of fact patterns where I've seen captives implemented and effectively utilized, touching on some of the things we already talked about. And I think that will probably take us close to the end. Case study one was a specialty retailer offering product warranties to customers for an additional cost. And they were in the business, not operating it within a captive, but they were able to defer the income recognition on warranty premiums from a tax perspective, treating them as advance payments, but then also carrying a substantial liability for that money that was unrecognized revenue. And the company was looking for a way to reduce those liabilities and transfer the risk of the future losses to another related entity, primarily for dealing with the users of its audited financial statements that had a hard time wrapping their head around the liability for unrecognized advance payments. So they established a captive insurance company to assume the risk on policies sold in those prior years and paid a lump sum to the captive to remove those unrecognized revenue and the cash from the balance sheet, thus sort of cleaning up the balance sheet by removing cash and liabilities, both at the same time for roughly the same amounts. But it was more, not so much of a tax play or a tax avoidance or strategy, but simply a balance sheet strategy to try to make things easier for the readers and users of the financial statements. Case study two was a distribution company with a large workforce, a large vehicle fleet, and substantial workers' comp, general liability, and auto insurance premiums. And they were simply looking for ways to reduce their third-party insurance costs. The solution for them was to join a group captive that pools the risks of companies in a similar industry, but that have better than average loss experience. The group captive is able to offer the same coverage at a substantially lower premium because it only accepts companies into the group that have a superior loss experience track record. The company essentially captures some of the underwriting profits that the third-party insurer was earning on their specific book of business. Typically, also what happens with these type of group captive arrangements is in order to participate, the companies are also required to implement and really follow through and document their participation in loss prevention programs. So it's really a win-win for everybody. But again, these group captives are very selective. Not everybody in the industry gets in, and that's why they're able to drive premiums down significantly for those that are able to participate. The third case study was the auto dealer selling extended service warranty plans on their used car sales. Typically what would happen without a captive is the company would earn an insurance commission on policies that they sold to customers that purchased their cars. And then the insurance company would pay the commission, but then they would earn all of the underwriting profit. Well, these policies tend to be fairly profitable, highly profitable. The premiums almost always seem to exceed substantially the losses that get paid out. So they wanted to participate in the underwriting profits. Their solution: establish multiple 831B companies with ownership that was spread across the various members of the third generation of the family. These companies assume a portion of the warranty premiums along with the related risk and earn the resulting underwriting profits. The underwriting income is not subject to tax because of 831B, and so these profits accumulate tax-free until such time as they're distributed as dividends or the insurance company is dissolved and sold.
All right, I am impressed. You did get through that within the hour.
Good, under an hour.
Great job.
Look at us. Wow.
Great job.
Hope everybody's still awake.
Exactly. There was a lot of good information and nuggets in there. Every time I hear this presentation, I do pick up a little bit more knowledge. So I want to turn it over to the Q&A. There is a section in the handout for questions that you can enter them in there. Please do so. I do have a couple coming in, so let me get the Q&A part started. So Mark has a question. If I were interested in pursuing this, where would I start and who would I talk to? I know you covered that in one of the slides, but can you give us a quick update on that?
Yeah, couple thoughts on that. Probably the easiest and in many ways the simplest is if you're in an industry trade group or there is an industry trade group that you can join that has, and many have, particularly with recent developments over the years, they've established these captive insurance companies within their industry trade group as a benefit to the members. If you're able to participate in one of those, that's probably would be my suggestion to start there, because they're only if your loss experience is good and you are accepted, you're going to achieve substantial savings with very little economic or tax risk and reap the benefits down the road of good loss prevention programs and lower premiums. Beyond that, if a single parent captive is something you want to pursue, then you typically got to find a good captive manager that can help you down that path of going through feasibility design and then implementation and ultimately in review and so forth. But a couple of the larger insurance agencies in town I know have experienced captive people on their staffs, companies like Lawley, M&T Insurance, both I know have experienced knowledgeable people in the captive area. On a national basis, there are companies that specialize in this. Companies like Captive Resources is a national company. Artex, ARTEX, Risk Management is another national company involved in this. I would encourage anybody on the call that has an interest and would like more information on that, feel free to drop me an email, and I'd be happy to share some of the people that I know and have worked with in this area. That might be the best way.
Great. And how long would you say, Mike, is the process typically to set one up?
Sure. If we're talking about a homogeneous industry group captive, those can be implemented fairly quickly, I'd say in as little as 3 months. If we're talking about a single parent captive, that's going to take a bit longer from start to finish, and at a minimum, at least in my experience, typically 6 months or so to get one of those set up and running.
Great. Mark B has a question. What is the decision points that drive a captive on where to domicile?
Great question. It really has to do with the nature of, and this is where your domicile advisor, your captive manager can really help you. But it really depends on the nature of your risks and how, from their experience, different domiciles are going to view your risks. And that, becomes an issue of setting premiums, but also an issue of, how much capital are they going to require you to put up to write insurance in their domicile of the type that you want to write. That a lot of times becomes the decision point is what's it going to cost you and the amount of capital that you need to tie up. And the capital needs to be typically contributed either as cash or as a letter of credit, which is pretty much the same as cash. So it is a financial commitment that you're making, and that's an important part of the decision process.
Great. Hopefully we got that answered for you. Yep, there you go. Good, Mark. And then Eric has a question. Would this be a good idea for a collision coverage for a fleet of 25 to 30 vehicles? Or would formation costs exceed the value provided?
It would be a question for a captive manager to walk through your loss runs. Typically, that's where the analysis starts. So Would your premiums be at a level that would exceed the threshold we talked about, 300,000, I guess would be a starting point. And then if that's the case, I think I'd start there. I think I'd start at whether that premium volume is there, and then doing a really hard examination of what your historical loss runs are going to be, or what they have been, to see if you'd benefit from carving your loss out from the general public experience, which is what is setting your rates, right? I mean, so the question is, if you're a better risk than the general public, then you may benefit from a captive. But if your loss ratios are about average or not a lot better, you may not benefit from incurring the additional cost of setting up a captive to cover those risks. If that makes sense.
All right, if you need anything, Eric, more on that, feel free to reach out to Mike. His contact information should be on the screen for you. As I mentioned before, I will send out an email this afternoon with a copy of the slides, link to the recorded session, the appendix that Mike referred to. I will send that out. You will get a quick survey when you log off, if you could give us any feedback, or if you'd like to talk with Mike a little bit more. Thank you for joining us today, and we will see you for our next webinar. Our next one is going to be in May, and it's going to be mergers and acquisitions. We're going to give an update on market trends and some different examples of some transaction successes. So we will see you in May. It's May 15th. Otherwise, have a great afternoon, everyone.
Thanks, everyone.